All right, welcome to This Explainer. Today, we're diving headfirst into the incredibly complex game of finance. We're going to start right from the ground up, looking at basic monetary constructs. What money actually is, and we'll escalate all the way up to the elite mathematical strategies used by Wall Street professionals. My goal here is to make these concepts completely transparent and, more importantly, actionable for you.
So here is our roadmap for today. We'll be hitting 1. The illusion of money. 2. Silent forces, inflation and interest. 3. Building your personal wealth. 4. Leveraging time and assets. And finally, 5. How quants trade markets.
Let's kick things off with Section 1, the illusion of money.
So what is the actual difference between a crisp dollar bill, a random stick from your backyard, and a digital crypto asset like Bitcoin? It sounds like a joke, right? But honestly, the reality of currency is far different from what most of us are taught. There's really no more innate legitimacy to that dollar bill than there is to a stick or a piece of code on a blockchain. The only reason a dollar, or a Bitcoin for that matter, has any purchasing power is that we collectively trust in its value. Whether we're talking physical fiat or decentralized crypto, the foundational mechanic is exactly the same. Money is, at its core, just an illusion powered by trust. It's a tool humans developed to make organizing society easier. But that trust, it is incredibly fragile. If governments print too much money, inflation kicks in, that societal trust erodes, and your hard-earned savings essentially turn into monopoly money. Historically, from the Roman denarius to modern paper money, overprinting always erodes trust. That specific fragility is exactly what decentralized crypto attempts to solve, but ultimately, every single currency relies entirely on shared belief.
Now, notice how banks fit into this illusion. They offer you some pretty great perks to hold your cash, right? It's safe, it's insured, it's convenient. But here's the kicker. They aren't actually locking your money in some dragon-guarded vault. No way. Through a system called fractional reserve banking, if you deposit $1,000, the bank immediately takes 900 of it and lends it out to someone else who wants to buy, say, a jet ski. You are the supply, and that borrower is the demand.
Moving right along to Section 2, silent forces, inflation and interest.
Notice the two faces of interest at play here. Simple interest, that's just a flat fee. But compound interest, well, that is your money's clones demanding rent. Compound interest can be your absolute worst enemy if you're holding a 20% credit card balance, where a single missed payment turns a $12 burrito into a $50 regret. But on the flip side, if you are investing at a 7% annual return, it duplicates your money like a cheat code. It is literally your best unpaid employee. But then we have inflation. It's not some overnight firework explosion. It is a slow, quiet erosion of value. You know the drill. You buy a bag of chips, it's half empty, and somehow costs 30% more than it did last year. Eventually, your $5 bill can't even buy you instant noodles. To combat this, you absolutely cannot just trade your time for a paycheck. You have to learn to trade your money for more money. Which brings us perfectly to Section 3, building your personal wealth.
Our sources highlight that getting rich is actually shockingly simple in theory. Just buy more assets. An asset is simply something that puts money in your pocket. Think a rental property that generates cash, or even a YouTube video you create once that pays you ad revenue every single month. A liability, on the other hand, takes money out. The reason most people stay broke is because they fill their lives with liabilities that they mistakenly think are assets.
And please, don't fall for the trap of mercilessly cutting out every $5 latte if you genuinely enjoy it. Instead, you need to implement a conscious spending plan. The formula is simple. Automate, invest, and enjoy. By automating your fixed costs and your investments first, essentially paying yourself first, you secure your future. Whatever is left over in that fourth category, well, you can spend that extravagantly on the things you love without an ounce of guilt. Let's step it up a notch in Section 4, leveraging time and assets.
I absolutely love this data because it is eye-opening. Look at Billy's trajectory. He invested only $15,000 out of his own pocket over just 5 years, starting when he was 15. Kim, on the other hand, invested a whopping $117,000 over 39 years, yet Billy ends up the richest at age 65 with $1.6 million. Why? Because wealth isn't built in days, it's built in decades. Billy simply gave compound growth the most time to do its thing.
But listen, you also have to protect that growth. See that massive $418,000 number?
That is exactly how much money you would lose over 30 years simply by choosing an investment fund with a 2% fee instead of a 1% fee on a $100,000 investment. A single percentage point difference in fees literally eats almost a quarter of your potential lifetime earnings. It's wild.
And finally, we arrive at Section 5, how quants trade markets.
The average investor buys a stock, crosses their fingers, and just prays the market goes up, right? If it drops, they lose. But quantitative analysts, or quants, operate on a totally different level. They actually don't care if the market is falling because they utilize a very specific mathematical strategy that allows them to manufacture profits out of total chaos. The secret mechanic they're using here is short selling. You're basically borrowing shares you don't even own from a lender, selling them immediately for cash, and then you just wait. If the company starts failing and the stock price tanks, you buy those shares back at the new, cheaper price, return them to the lender, and you pocket the difference. You are quite literally betting on failure. By combining these two strategies, quants execute what's called a pair trade. They go long on a strong company and short on a weak company in the exact same industry. This effectively insulates them from overall market crashes. It really doesn't matter if the entire stock market goes down, just as long as the strong company does better than the weak company. To find that perfect match, they map out daily historical returns on a bell curve. The mean is your expected return, and the standard deviation represents your risk, or how spread out the values are. By using high-dimensional math, they can calculate the exact correlation, risk, and return between hundreds of different companies to find those perfect pairs. So let's actually see a pair trade in action. The quant shorts Omega to generate $1,000 and then uses that exact $1,000 to go long on Alpha. Fast forward and the market crashes. Both stocks lose $5 in value. But look at the returns. Alpha only dropped 10%, while Omega dropped 12.5%. Because Omega fell harder, the quant buys it back cheaper, sells Alpha, and walks away with a $25 profit without having spent a single dime of their own capital upfront to initiate the trade. How crazy is that? That right there is the power of truly understanding the mechanics of money. As we wrap up this explainer, I want you to remember this quote from Jim Rohn. Real wealth isn't just a pile of cash sitting in a bank account while inflation slowly eats it alive. Real wealth is the learned skill of understanding value, leveraging your time, and creating mathematical systems that generate money for you while you sleep. Because ultimately, your time is the most finite asset you will ever own. So I'll leave you with this question. Are you settling for a poor exchange rate, trading away your hours just to survive? Or are you finally ready to use the rules of leverage, assets, and time to become the architect of your own wealth? Think about that for a bit, and I'll see you in the next explainer.